What is up, everyone? This is Warren Howe, and I hope you're having a great day out there. So today we're gonna talk about portfolio diversification and net worth allocation. Yep. So I prepared some slides for you guys. Basically, these are the things that I'll share with my group coaching. As you can notice as well, I'm in a different background. This is because I am in my brother's room, actually quarantining myself. Got close contact and whatnot. So yeah, I'm here, right? I'm at home. I'm in my brother's room. But that being said, let me share my screen, and we can get going. Portfolio setup and diversification. First of all, we need to know, and the reason why I'm doing this is also because I think one of you asked, let's talk diversification. How many stocks should we have? What is your net worth allocation? Or I think you were just asking about diversification, right? And that's where, and I repeated this several times before, it's just that I think we need to have a handle on things when we want to sort of navigate how much net worth do we have. We want to navigate how many stocks we should have, right? We want to navigate what are the types of stocks, and we need to dig in further in terms of how do we build that portfolio blueprint. So this is very important. And I think that before anyone starts your stock investing journey, seriously, anyone, you need to ask yourselves and dig down, what type of investor or trader are you, right? So notice I said trader. The reason why I say trader is because you need to understand that there are several strategies that we can actually adapt in the stock market, right? Because the stock market is different than owning a private business. It's similar if you have the same mindset, but it's different in a way that we can actually take advantage, right? So that's what we are trying to preach in here, with me, FATA, we call it FATA, fundamental analysis and technical analysis. And that's why I actually have that public portfolio. So later I'll be showing that screenshot of the live NAV, net asset value of the public portfolio. But let's talk about portfolio setup first and diversification, right? So, but before that, obviously, before we start our investing journey, let's assess our net worth. Yeah. Now, a lot of people, I'm not sure if you guys assess your net worth and you keep track of your net worth. Let me know in the chats. Let me know in the comments and put their net worth so that I know that you know. And by the way, guys, you know the drill. If you're watching this live right now, smash that like button. Yeah, show our brother some love. Smash that like button. Click hashtag live if you're watching this live right now, so that we know you're here. And again, if you got any questions, put in the chats. So net worth portfolio allocation. Before we begin, I mean, it's always important to track down our net worth, right? Even if it's small, like 10,000 or 30,000, whatever it is, it doesn't matter, because we need to track down what is our risk profile end of the day, right? So let's say you have 30,000, and what does it mean by tracking down our net worth? What does that mean? It basically means, obviously, you guys already know how much assets worth that you guys have minus the liabilities. Yep, that's your net worth. So for example, you got value of your home, value of your vehicle, your cars, right? Your checking and savings accounts, your cash, CDs, your retirement accounts. You have all of that. And if you sell it off today at market value, and you can assess yourself, right? So net worth is the sort of thing that it is more, it's just based on numbers in a way. like these numbers on the screen, to be frank. Like, so let's say you recorded this in your Excel sheet and you update it every 3 months in a way that, okay, your house value is worth this much. Okay, the property market, I know in the US the property market went up like crazy, but you update this sort of every 3 months or whatever, 6 months, 1 year, and then your value of your assets go up, thus having your net worth go up. But the thing is, we also need to consider liabilities, right? Now, that is net worth, but we can't lie to ourselves, right? We can't we need to, what is more important in terms of net worth is liquid net worth, right? Your liquid investable net worth, because people, they work their lives, they work 9 to 5 every day. they come back, they chill, they Netflix and chill, and then they, life goes on, and then 9 to 5 again, and in an instant, you're already like 40 years old, 50 years old, right? What is important here is to keep that liquid net worth strong, that liquid investable net worth strong, so that we can compound our wealth, right? So for those of you that, and don't keep track of your liquid investable net worth, it's very simple. Basically, how much liquid cash that you guys have, right? To be playing around and growing your money, right? Now, this is important because similar to a company's balance sheet, right? Similar to a company's balance sheet. Now, a company, they have cash and cash equivalents, they have total assets, they have total liabilities, they have current assets, they have current liabilities, right? So similar to your balance sheet, your company's balance sheet, they have cash and cash equivalents, basically how much is in the bank, and that can be liquidated within 3 months, or even short-term investments. Yep, 3 months to a year. That is exactly the same, because if we want to assess how much cash the company has, you need to work out you need to work out how much they have in short-term investments. And they could be buying bonds, they could be loading it out 3 months to a year, and basically money in the bank. So that is the liquid net worth of that company per se. For individuals, it's the same thing. How much is in your bank? How much sort of bonds do you have or whatnot, right? So that is liquid. That is your liquid investable net worth. So the name of the game is, we identify how much is our net worth. We identify how many asset classes that you think you can put your money work for you, right? Because the end of what we want is, we want to reach our fuck you goal, our fuck you money, right? FY money, I call it. What is FY money? Basically, the money in the bank when you retire, so that you can say F you to your, your ex-boss or whatever it is, right? That's the concept. So that's the reason why we should have, tracked down our net worth. That is the reason why we should track down our liquid net worth, because, liquid is very important. If you were like me last time, where I was asset heavy, right? Huge liabilities, because I own a lot of properties. I'm from the property background. And well, sad to say is that I wish I started early on stocks. Seriously, I started real investing 7 to 8 years ago. But my point is, it wasn't healthy, simply because it's not liquid enough. All of my assets, they are very illiquid, right? I got a lot of homes. I don't really, seriously, I don't shop much. I don't buy luxury goods much, because I believe and I know that I'd rather work hard now to be working hard later, right? So I'm saving up, I'm investing, I'm growing compounding my wealth. And, I'm very lucky today. I got, a sizable amount. But my point is, we need to differentiate what is liquid and non-liquid, so that we know how to grow that cash later on, right? So when we talk about non-liquid, we talk about houses. When we talk about cash and stocks, we talk about, liquid, right? The other thing to ask ourselves is, how many, like in a scale of 1 to 5, what is the type of asset class, which asset class, yeah, do you think will compound your wealth, your net worth substantially over time? Now, you guys are in this group, you guys already know the answer, right? Stocks, equities, stocks, whatever you want to call it. This is, in my opinion, it's the best asset class in the world, in my opinion, right? Because companies, they grow. And we covered this before. Why do companies grow? Companies don't just grow because, okay, the whole world is, the whole S&P 500 is going up. But there's a reason why S&P 500 is going up, right? Because of population growth, dependent on the country, because companies grow themselves, technology, they bring up everything, because of inflation, right? Obviously, so inflation goes up, stocks will go up, because that's why better profits, better earnings. The whole game changes as long as everyone is growing And if inflation is healthy somewhat in that country, that means asset prices will always go up. That's because demand always goes up, right? Population growth. So if that goes up, and we have an asset class here, which is very simple. Just invest in the S&P 500 if you could, right? Or individual stocks. Now, the individual stock, if you are patient enough, you can hold them for long term as long as you assess the management, where they're going to go, the strategy. You can predict their path to profitability or predict their profits or revenues. Then you are better off by owning a piece of a great business, right? And that will propel your net worth further. And that's where I come in to say, okay, if you have a 10,000 net worth, it doesn't make sense to be diversifying fucking 10 stocks, 15 stocks. It doesn't make sense. That's because imagine, right? You have 10 stocks, and let's say you will need to double your net worth. You will need all of these 10 stocks on average to double up, right? So that you can, because you got 20% on a particular stock, you got 5% on a great stock, you got 3% of an even better stock. So they have to perform really well to be growing your whole net worth. Yeah. And how often can you get all of your 10 stocks or 15 or 20 stocks to double up in X amount of years? Like how often? And this is how we need to assess everything logically, realistically, right? So let's say you have a target that, everyone has a target. I want to grow my net worth by 2x in a year. Now, the logical question is, okay, how are you going to get there? If your net worth is 10,000, if you don't have any value, you don't have any houses, you're liquid, right? You have more liquid cash, you have more liquid investments. 10 of your stocks needs to double up in 1 year for you to grow your net worth in 1 year. Now, you can also include, okay, how much I'm going to, save up from my 9 to 5 or my side hustle, whatever. That's great. Or your own business, if you have, then yeah, you can double up your net worth in 1 year. But if you don't, then you need to realistically ask yourself, okay, out of this, 10 stocks, what is the likelihood that them going to 10x? Why are they going to 10x? I'm sorry, 2x, because, well, out of your 10 stocks, I mean, you could be, in a scenario like now, you could be investing in growth stocks, right? And growth stocks are getting a hit. So what are the chances that these growth stocks will actually 2x in 1 year? It doesn't make sense, right? So stocks don't work that way. Some stocks will go down, some stocks will go up. And on average, if you is diversified. The good thing about that is diversified, right? You got 10 stocks. So let's say some do bad, some do good. You are hedged, right? So you can aim for that 15% per annum or 10%, whatever it is. But my point is, we need to set up our net worth, our blueprint, right? Our portfolio blueprint. Yep. So portfolio blueprint means, knowing how much is your net worth, knowing your goal, what is your liquid assets, because actually liquid net worth is the most important thing. And in a way, it's taking control of your lives. Also assessing how much, monthly cash you can actually put it in so that you can work out your cash flow. So do you track it down? How much is your net worth? We could start with progressively checking down your daily expenses. Because the name of the game as well, when we talk about fuck you money, we need to identify how much do you need to retire. We need to work things backwards, right? So the concept is you work out your daily, and everything is actually, the root of it is how much expenses do you need, right? A month. So let's say right now, if you were to survive, and I'm in Malaysia, right? Let's say, well, for my kids, for my whole family, I'm spending around 25k ringgit. Divided by 4, it's close to, my maths fail. I think it's like 5,000 USD ish, 6,000. Yeah, 6,000. So that's how much I'm spending for, me and my family. And that's decent in a way, but you can't really convert and spend it over there because the spending power is different. In Malaysia, it's actually cheap as hell. And by the way, if you guys come from US here and you have like a retirement home here, you can live like a king simply because of, the currency and whatnot, right? But my point is that's I need to identify that because I'm a breadwinner, right? I have 2 kids, I got a family to take care of. So those are my expenses, right? And I live frugally, seriously. Um, I got people, who are 50 years old living off 50,000 a year in the US, and that's practically nothing, right? That's practically nothing. So what I'm trying to bring out here is that we need to identify what is the worst case scenario and how much do we actually, earn, need to earn a year so that we can actually survive. Like that's the bottom line, and that's the most important, right? Because you need to survive. Then after that, you need to work out how much do you need as you grow older, right? um let's say 40 years old, 50 years old, or how much do you need when you retire? Yep, it could be the same amount, it could be more, it's up to you, but we need to work that out because this is the root cause, right? The root cause is we work out how much the daily expenses and the yearly expenses. Then you work out how much you need when you retire, so that you need to know what is your fuck you money, and you times that all the way. So for example, if I want to retire at 50 years old and I'm spending 5,000-6,000 a month, right? That will bring you to like 72,000 a year. 72,000 times, how many X amount of years to retire? Let's say I want to retire at seriously 50, which is 16 years from now. You take that amount, you times by 16, that is your fuck you money. That means your liquid net worth. Liquid mean, that's why that's the importance of liquid, because we need to assess that liquidity and we need to assess how much you can actually spend when you retire, right? And just live freely, right? So that's the amount you want. That right there is your FU money. Yep. So let's say that amount equates to 2 mil. That means your FU money, you need to reach 2 mil or 5 mil, whatever it is, by 50 years old. Then you can retire nicely, right? Well, actually, the concept is that, but I worked it out wrong. Sorry. So when you work that out, you need to also work out. Okay, that when you work that out, that means 72,000 times 16. That is how much money you get when you retire and you stop working. But let's say you want to live on, obviously we want to live on more, but you can actually have that in until 90 years old, right? Let's say we cap an age till we pass away at 90 years old. Yeah. Technically, how much you need to actually have for your FU money will be, I got it wrong. Sorry. I was last time I used to do this, but I haven't been touching them for so long, right? Advising on people on how to do that. But my point is, okay, so let's say you want to retire at 50 or 60, and let's say we cap an age that we want to retire, right? Let's say 90 years old. The concept is during that 30-year gap, right? We need to assess how much we need to survive, because when you retire, you got no sort of income already, right? You're not working physically, you're not having active income. So what we do is that we need to assess, okay, how much we need when we retire, right? Again, working on that root cause, working on that per annum amount, you times by 30 or 40, whatever it is. 50 to 90 is 40 years old, whatever it is. And then let me bring up my calculator. And what we do is we times that figure. So let's say I have 72,000 times 40. Yeah, so 72,000 times 40 times, yeah, because 72,000 a year, right? So let me work out 60,000. 6,000 times 12 times 40. That'll be 2.8 mil. That'll be 2.8 mil. Yep. So the concept is I need to have 3 mil to retire comfortably, right? And not doing anything. That's the FU money. Yeah, I need to have 3 mil. I'm working backwards here, right? 3 mil is good. 2.8, 3 mil is good enough until I pass away at 90. And imagine not having to earn anything. I can just pay off because I'm living on 72,000 USD a year, right? That's the FU money right there. Yep. So the question is, how do we reach to that FU money? That's why I was asking, in a scale of 1 to 5, what is, like, on a stock asset class? What would you rate stocks as an asset class that will further bring you to your FU goal? right? Because that's the minimum amount that we need to have. And that's just liquid, right? We have to think about it. So the question is, if we start off with 10,000, can we reach to 2.8 mil in X amount of years? Now I'm 34, right? That means I have 16 years. I don't want to retire at 50, to be frank. I love what I do. So I'm going to retire at 60. But one of my question is, you need to have your whole life planned out. Yep. Now what we did was we worked out our FU money, right? I mean, for example, yours could be different, but we worked out that we need 2.83 mil USD by 50 so that you can live off freely without having any income, stress-free till the day you die, 90 years old. Okay, so we worked that out, 3 mil. What we need to work out as well is with the amount that you have, that's why it's so important to assess your net worth. With the amount that you have on liquid, good enough for liquid investments, we need to grow that specific amount, whether it's 10,000 or whatever it is, to 3 mil in the duration and the time frame that you think you're going to retire. So let's say I want to retire at 50 years old and I'm 34 right now. I have 16 years to go to compound that asset class, to compound that wealth. So I believe stocks is going to get me there. I'm already there, to be frank. But my point is, we need to seriously work this shit out now, right? Your liquid net worth, where are you going to go? What is your retirement money? What do you want? End of the day, because this is taking control of your life, right? So again, work out your FY money. Work out how long you need to retire comfortably, right? Work out how much you need a year to be spending on. Work out how much is your net worth, liquid net worth today. Identify your asset class that you will bring you there to your 3 mil or whatever it is, 5 mil. Identify how you're going to get there by building thesis, which type of stocks that will grow in 16 years, where's it going to get you. And that is like eyes on the prize, right? We don't care about short-term fluctuations. This is net worth and portfolio diversification. Yep. So tabulate your expenses, track down your net worth and how much is in each asset class. How many percent should be in cash, property, savings, stocks, whatever it is, right? So how should we do it? Would you spend that much in your honeymoon? See, when you do these and you live frugally, now I'm not trying to say don't spend your honeymoon, okay? Like, ladies, don't kill me. But my point is, you need to work out, for example, if your net worth is 30,000 or 15,000, whatever the heck it is, and your honeymoon costs you 5,000, you are spending 30% or 5, it could be more. Honeymoon is not so cheap, right? You could be spending 30% of your net worth or even your liquid net worth into something that is not going to get your money back. Sorry to say. Have you been assessing this? Like, if you assess this in that way, it will make you rethink about living frugally. Now, when it comes to life, when it comes to having a partner, you guys should work things out together, right? That's the point of having a good spouse and a good partner. So you guys should work as a team to be saying, okay, this is like 30% of our net worth. Let's dial it down, right? We can always go on the honeymoon when we earn more money. So it's all about perspective, right? So yeah, that's what I want to say. That this is net worth tracking. We identify our FY money. So when it comes to net worth, this is what I think we should segregate. In terms of percentages, right? Now, equities have always been, it's the best asset class for me. It's always the best. And I believe that I can grow my wealth from FATA. Even if it takes 16 years, 10 years, I've been growing it like, crazy. So I believe that should be the highest, right? Again, you don't have to follow me, but I believe this should be the highest, right? So 35%. And I believe that we should have stake in companies. Now, to propel our net worth further, we need, in my opinion, right? Because let's face it, having a 9 to 5 is you'll never get rich. It's not a myth. Like, it's not a newsflash. You'll never get rich. You'll never get wealthy from working 9 to 5. So what we need to do is we need to diversify our money in terms of like having stake in companies. Now, stake in companies could be investing in your private investments. It could be you having your own business. It could be you investing in your friend's business. At least there's a chance for your money to be potentially 10xing your net worth to shorten your FY money's, period entirely, right? So let's say you have 10,000 in your friend's company. And it's the same thing. Why are you investing in your friend's company, right? Why are you investing in Apple? Why are you investing in SoFi, Tesla, whatever it is? You assess so many things, and maybe you'll be assessing more. You'll be asking your friends, direction even more. Like, so what do you ask? You obviously, before you invest in your friend, you know that he or she is a good entrepreneur. They can, they are responsible. They can grow money. Blah blah blah. Right. That's number one. Number two is that what type of business? What is the market they are capturing? Is it niche? Does it make sense? What is the marketing strategy, right? Three is probably what is the projected earnings that your friend is probably going to pitch you, on how they're going to grow their money and whatever, how they're going to utilize your funds, right? So I believe we need to have stake in companies simply because it trains us to be better investors. We are asking the right questions. These are exactly the same thing when it comes to stocks, right? So you need to work out a projection, a buy plan. What is the sell plan? And when do you think that this business, in your opinion, as an investor, is good? Because you can have the flexibility of sort of wanting to cash out. Now, the bad thing about private investments is that you need to find a willing buyer, right? Willing seller, sorry. You're a willing buyer, right? You are the seller. So willing buyer, willing seller, you can actually exchange, you can sell your company off, you can trade shares on a higher value. But these are three essential things when it comes to, owning a business, and whether or not before you put that money into the business, you do it. But the point is, private investments can be sexy because they can capture a good market, good TAM on their own, and they can grow 3x, 5x, right? And imagine 30% of that 5x will be probably 2x of your whole net worth in 3 years, right? So that's good. And others, it could be currencies or whatever it is. Then we got savings, cash. So keep it simple, keep it lean, right? What is important here is that this is very lean in a way that it's liquid, right? So don't be like me and I'm opposite of this. I was like 50%. I was worse. I was 80% property, it's not liquid as hell. I got huge debt last time, and I had cash. I wanted to grow that. So I thought to myself that everything that I'm saying to you right now is actually what I went through before. Yep. I grew my net worth slowly through stocks, through equities, and stake in companies. I sold a few companies. Unfortunate. Where do I put it? I want to be more liquid, right? I put it in stocks. So when I put it in stocks, I can, fortunate enough to grow that money wealth until today. And right now I'm sort of 40-60 stocks, 40 property, right? I also sold my property, and where did I put it? I put it in stocks, right? So my point is, because why am I doing that? Because I identify my FU money and my FU goal, identify how much I can potentially grow my stocks with. So for example, if you have like a 30% or 20% per annum sort of goal, that compounding effect will be very powerful, right? It doesn't matter even if you start with 15,000. So you need to have three elements, right? 15,000 you start off with. You need to have monthly cash inflow into that same stock account so that you can compound later on, and you can identify whether or not 20% is very reasonable. If you compound that amount in 20 years or 16 years, 15 years, you will have 1 mil easily. Yep. And that is just that liquid amount that you can get to. 15% will get you 1 mil, not mistaken. 20% it can get you. We can actually have that calculator here. Let's see. And I think we did this before, but let's see regardless, right? So let's say you start off with 20,000. Your monthly contribution could be 2,000, right? Let's say 16 years. I'm not going to retire at 50, but let's say 16 years, and you can get 20%. So it's already close. Like in 16 years, it's already close to how much you want to get. So if it's not close, then we need to work harder, right? So mine was 2.8 mil. This case is 2.4 mil, right? Liquid cash. Remember, this is liquid cash. This is not including your selling of your properties or assets, whatever it is, right? So my point is, this is portfolio blueprint. We need to do this, right? Now that's why we're actually doing this, showing the public portfolio, because some people may just have a net worth right now of 10,000 and they have only 3,000 put in the stock account, right? So, I mean, the reason why I'm showing this is because I'm not afraid. Like my capital, because I put in 500 USD and 3,000, my capital is 3,005. My NAV, or whatever you want to call it, NLV, how much if you were to liquidate everything today, I can get only 3,003. So I'm actually down. I'm actually down $200, but I'm fine because I'm holding two stocks that I love, right? I'm holding it for the long run, but I will adopt. Right now I have quite heavy cash. I got 40% cash. I can actually use that hopefully when the market gets better to be trading in and out. So I haven't been doing any purchasing for the last 2 weeks. I want to keep it that way, obviously, because also I was on a holiday, but I want to keep it that way. And I want to just, wait out to see what other opportunities are there and build thesis I'll be sharing with you guys. So yeah, this is what I think. As we grow, we need to grow our capital, diversify. For those of you that have a plan to actually own a home later on, feel free to do that. But just to tell you, we don't want to own a house if we can't pay off, because the concept is the bank owns it, not you, right? Until you pay them off, you will own that home, right? In the title, I'm pretty sure in US it works the same. They'll have like the bank has that name on the title, so technically it's not yours, right? You need to be able to be paying off that leverage, paying off installments, right? But if you want to do own a home, then this is my segregation, which I believe will make sense, because end of the day, equities is going to be top, right? I still think we need stake in companies. Real estate could be 23% of your net worth, could be more, but how do we work out that that net asset value will be the price of the home minus of the liabilities, then you get the net value, right? And it could be little if you owe the bank a lot. If it could be a lot, it could be a lot if you pay off the bank, frequently. But this is where I think this is a very healthy net worth scenario. But at the end of the day, why are we doing all this? Is because we need to know our blueprint, right? What are we? So blueprint involves, okay, now we identified our FU money, we identify our net worth. Let's talk about how to get there, right? So how many percent of a growth stock person are you, right? And are you willing to adapt shorter term swing trading mentality or strategies into your portfolio, right? It could be 30% of your port, like me. In this public portfolio case, it could be 70% or 100% long term. It doesn't matter, as long as you need to have more liquid and be able to reach your goal faster, right? So, and all this makes sense, right? So basically, if you guys work out, what is the strategy, you don't have to be a swing trader. You can reach your FY goal just by being 100% long term. It's just that we need to be more we need to be more, in my opinion, active in the market, right? So there are always deals, like one click away. Seriously, if you think about it, when we look at the stock market, right? And if we look at Upstart or TTD is a company that I have. TTD is a company that my convictions are high on, and they're not earning money, but just by reading market cycles and sort of reading the trends of momentum, we could potentially pocket off 28% in 2 weeks, right? So now I'm not trying to show off to say I did, but I'm trying to say, and you might seem it's a gamble, but it's not, right? If we trade without emotions, if we trade with conviction, if we trade with price action, whatever it is, different strategies we can adapt. What I'm trying to say is the stock market is always pricing things early. So we can actually have an easy 10% or 15% in 2 weeks or 1 month. Obviously, we need portfolio management, but that is very possible, right? That is very possible. Drop me a DM if you guys want to know more about that. But end of the day, we need to adapt certain strategies. Now, this could be too much for you, and you could be 100% long term, which is fine. So we need to adapt. We need to assess out of your whole 5 stocks or 10 stocks, whatever it is. We need to ask ourselves, okay, if you're a long-term hold, it's all about valuations, right? So how much of a valuation do you think that these companies will deserve in X amount of years to hold? Because you're long-term, right? So that will basically propel your net worth further, right? Inclusive, and whether or not you need to assess on a year-on-year basis their performance, whether or not per annum has been reaching on a CAGR of, an average of 15%. So if let's say your 10 stocks at 15%, then okay, getting 15% in your, calculation will make sense. Or if you want to be more aggressive and you have that short-term, long-term thing, then maybe you want to be more aggressive and say, okay, I want to have 25%. So an increase of 5% over the long run will double up what you initially have, right? So we've got to work harder. Yeah. Then that is portfolio blueprint. Other than that, we need to know, we need to, in my opinion, we need to practice focused investing, right? So you can see these are my high conviction stocks, right? I'm not going to sell them, hopefully. I'm not going to sell them. I may rebalance, but I'm not going to sell them too much if I'm going to hold it for long, right? For the long run. So focus investing means all we need are 5 stocks. All we need are 6 stocks, right? To be really propelling our net worth. And during a bull run, obviously these stocks are going to perform great. But we need to assess also whether or not these are high growth, low earnings, or profitable, where are they in the life cycle, all of these things, right? Now, the reason why is because in this market now, you will expect, more weakness. But if we can average down, and if your monthly cash flow allows it, we can average down in DCA on better stocks over time to be owning more shares. The name of the game is owning more shares. So I'm imagining myself, right? I got 10,000 net worth, 3,500 is in stocks. My concept, knowing what I know today, my idea is to own more and more and more and more shares of Tesla. Tesla to me is a no-brainer, right? They have, they got huge progress, whatnot. So what I'm thinking right now is that, okay, for my college, my kids' college funds, right? For me to reach my FU money, I need to have more and more shares of Tesla or a company, my winners, basically. The concept is piling onto your winners, right? So that is focused investing. That is a portfolio blueprint. Now, you don't have to follow that. You can have, 15 stocks to diversify, but it doesn't make sense if you're having a, too big a portfolio. Too small a portfolio. So, dividend doesn't make sense in my opinion. Growth investing makes sense, right? Focus investing makes sense. We want to be piling onto our winners, right? It doesn't matter if it goes up 100%. We don't sell simply because we want a compounder, right? We want 1,000%. We want 2,000%. So, but obviously it depends on what type of stock, right? So far in Tesla, it's easy. And I built thesis before I've been sharing with you guys. So that's different. But yeah, I hope you guys got some value out of this today. Basically, we talked about portfolio diversification, net worth allocation. We want to know how many, we set a portfolio blueprint. What is your FU money? How many stocks we should have? A better perspective. And again, let me know in the comments. Are you guys dropping anything? Yeah, let me know in the comments if you want to know anything, or you want me to build a thesis on anything, right? So again, I'll be seeing you guys next week. Drop any, let me know if you want me to assess on financials on a specific company. Now I know, sorry, there was this request on ISRG, but I was looking at it and it's a medical healthcare company. So to be frank, I could do that next week. Sorry about that, but the reason why I didn't do that is because my confidence level is not exactly very high on healthcare companies. I'm never good at healthcare companies, and I could quickly do like a lazy assessment in terms of their financials if you want, or any other company. So yeah, again, hope you guys got some value out of this today. Smash that like button. Click hashtag replay if you're watching this on replay. Click hashtag live right now so that I know you're here, and I'll see you next week, guys. Thank you.